Hi, everyone. My name is Andy Webb, and this is Daniel Rasby, and
Hello.
we want to welcome you to our webinar here today on how taxes, risk, and fees affect your income in retirement. So, Daniel, they say that two things are inevitable in life, death and taxes. Can you
Right.
really save people money on taxes?
Well, yes, we can, and we use a number of strategies to do that. Most of our clients, on average, save over $1 million in taxes. So it's definitely something that we can save about.
Wow, that's a tremendous amount, $1 million. This could be worth $1 million to somebody.
That's right.
How about risk? I mean, they say you have to take risk to get reward. Is that true?
Yeah, the no risk, no reward is kind of a myth. Sometimes it's true, but often risk and reward are not linked, and sometimes taking less risk can give you a better result.
Okay, great. And how about fees? You have to pay somebody to manage your money, correct?
Yeah, well, a lot of people pay 1% to their advisor, but we're going to show you how paying a 1% fee can actually eat away 31% of your growth over time.
Wow, that's an incredible amount of growth. I'd rather have that in my pocket than my advisor's pocket.
Exactly. And so we'll get into that, but we're going to focus on taxes today. And so, first of all, we have this video to share.
Ben, where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses.
But it's okay. It's part of the game.
No, it's not.
It
It's not fun.
It's not fun to what?
It's the worst part of the game.
Oh, it's what?
Taxes.
It's the worst part of the game, taxes. So that's how you feel. We agree with you. The three biggest killers in retirement are those risk, fees, and taxes. They are killers. And if you minimize or eliminate those three killers, everything else gets better in retirement. So we're going to talk about that. And here's who we are. This is Andy's family here on the right.
Yeah, hi, I'm Andy Webb, and this is my family. We have 7 kids, and as your dad says, yes, I do know how that happens. And I only have one wife, and we have 5 grandkids now. So the family's growing. Everything's great.
Cool. And this is me and my wife on the other side of the screen, and we have 2 kids so far. We're just getting started. Maybe we'll have more soon. But right now we have 2 kids, and they're 3 and 1. So that's our family.
Those are the best ages.
And when I'm not doing tax attorney advice, I work in a ministry called Conquered by Love, which is an adoption help ministry where we help strengthen family relationships, especially with adoption, but with all families, and improve parent-child relationships and sibling relationships and so on. So that's conqueredbylove.org. And with our 2 companies, we have Higher Ground Financial Group and Higher Ground Legal. And Andy here is a distribution specialist with Higher Ground Financial Group, and I am a tax attorney with Higher Ground Legal, and that's for estate planning, wills and trusts, as tax advice. And then Higher Ground Financial Group deals with distribution planning, retirement planning, minimizing risk, and so on. And it's pretty much all virtual. We see clients exclusively on Zoom or on video calls. We do have clients all over the country, on the East Coast, on the West Coast, everything in between. And you may have seen us on Fox Business, on CNN, other places, Bankrate. We have a couple of radio shows as well, one on each coast, AM 570 in DC, and then 560 KSFO in San Francisco. So you can catch us there as well, or you can go to our podcast everywhere podcasts are available to download. You can find the Higher Ground Financial Group podcast for Optimize Your Retirement. And our website is, again, those 3 killers, riskfeestaxes.com. And so that's really important to us. We want to reduce those things. So what do we do for our clients?
Well, the main thing we do is we help them reduce taxes, we help them reduce risk, and we help them to reduce their fees so they can have their money last longer. And, because there's 2 things in retirement that I think most people are concerned about. One is they don't have enough money to retire, or 2, they're going to outlive their money.
Exactly. And so if we reduce risk, fees, and taxes, it increases your income, it increases your protection and your confidence level, it reduces your stress, and you help pass more to your family. Now, we are fiduciaries. That means we're required to act in your best interest at all times, except for today. This is a educational webinar, and so it is not specific advice to any particular person. It's good information. It'll be general information, but don't take it as specific advice without getting fiduciary help on your specific situation. We put together plans for our clients, and we want to show them what difference it makes with us versus without us.
Right now, out there on your own, your life expectancy is like here. With me, it's here. Without me, here. With me, without me. With me, without me. So, I would advise going home, but you know, it's up to you.
So just to be clear, we're Tom Cruise in this area.
Well, this is a great movie. You know, it's night and day, and it's not really your life expectancy, but it's your money's life expectancy.
Exactly. So your money, we want your money's life expectancy to be as long as possible, and so that's by reducing those three killers: risk, fees, and taxes. Anybody recognize this guy? Put it in the chat if you recognize who he is.
I think got a few
Any
people that are...
Star Trek fans might recognize that. Yeah, this is Lieutenant Commander Data, the android from Star Trek, and that's his whole picture. Now, if you're not a Star Trek fan, I'm a massive Star Trek fan.
I am not, but I like Star Trek.
Okay, well, but
I think I would have recognized Data, though.
Well, but if you're not really a Star Trek fan at all, you probably wouldn't recognize him, and the first picture would only be insufficient data. Yes, there's more where that came from. Insufficient data leads to poor choices, so we want to give you complete and proper information to make good decisions about your money. So first of all, let's talk about the tin can. Andy, what does this have to do? First, tell us the history of the tin can. How does that?
Okay, well, if you're not familiar, Napoleon wanted to conquer the world, and his army could only go so far as his food and supplies would take him. So he put together a contest because he wanted to preserve food, and somebody came up with the tin can. They invented it in 1810. Did a great job of preserving the food, but there was a problem, and the problem was the can opener wasn't invented for almost 50 years. So the instructions were to take a chisel and a hammer and take out the food. Well, obviously, when you do that, there's going to be some waste involved, and
it's a lot of work to get it out.
Oh, it's a lot of work and a lot of effort, and a lot is spoiled. So what does this have to do with retirement? Well, you've worked 45 or 50 years to stuff all your money into this tax deferred can. And now we have to find the most effective and efficient way to extract that with the least amount of damage. And we want to do that by reducing risk, taxes, and fees.
Exactly. Okay. So what is our agenda for today? Excuse me. Risk, fees, and taxes. If you haven't gotten that theme, that's we're trying to make it clear. We're going to spend a little time on each of those and focus mostly on taxes today. And so let's start with and we'll have time for maybe some question and answer, but most likely put it in the chat and we'll try to get back to you. And you can also click the link and schedule a meeting with us, and we'll be happy to give you one-on-one information there. So the link that's popping up, go ahead and click that link and schedule the appointment with us so that we can talk to you, or you can go to riskfeestaxes.com as well. And so we had a bear market 2 years ago or more in 2022. That was a really bad year. And that was followed by a really good year in 2023. And what does a bear market mean? It means it lost more than 20%. And so it ended more than 20% down. And then the recovery was fairly quick. And so if you didn't take any money out for about a 2-year period, then you would have just about the same amount of money you had 2 years ago. And that's a little bit depressing for some people.
To have nothing more than what you put in 2 years ago really is depressing.
But you know what? That's actually the good news, because the bad news is if you were retired and you had to be taking money out, then you'd have a lot less and you would probably never recover. So bear markets hurt you a lot more in retirement than they do while you're working, because you have to take money out every year. You ever heard this phrase, buy low and sell high? Well, when you're retirement, you don't pick when to buy or sell. You have to sell every year. You have to spend money every year. It's got to come from somewhere. So bear market's a really big killer in retirement. Okay?
And you can't determine when they come.
No, we don't know when the next one's going to come. Then there's this word, inflation. You haven't heard this word recently, right? It's all been solved. There's no inflation. It will never exist again. No, I mean, inflation obviously is still a very big factor should be a very big factor in your retirement planning, but what can you use to your advantage? Look at this headline. It said Miami had rent inflation of 39% over a 2-year period.
I'd hate to be renting.
Yeah, but if you own the property, then it can be a really good inflation hedge, right? Because
Correct.
Your mortgage stays the same, but the rents go up. So rental properties can be a very, very good inflation protection in retirement. Now, what do you normally do when the market's crashing? You move to bonds, right?
Yeah, that's what they say.
Yeah,
you want to have something that's safe and secure.
But the bond market dropped out entirely over the last few years, and especially while the market was crashing in 2022, there were trillions of dollars of losses in bonds. Now, why is that? Because interest rates were going up. So shouldn't that be good for bonds because you can get a better interest rate now? How does that work? Why was it not so good?
Well, the problem is if you buy a bond at 2%, and then the interest rates go up to a 4 or 5%, okay, then your bond becomes less valuable. And if you wanted to sell it, you're going to have to sell it at a loss.
Right, because I mean, I'm not going to buy your 2% bond when I can get a new one for 4, right? So that's the reason that the bond prices went down, and that caused a lot of frustration and stress from people because they didn't know where to turn. Right. Stocks are losing money, bonds are losing money. What do you do? And over the next several years, maybe the interest rates will come down. We'll see. And then you might have the opposite effect. Bonds may be a good place again, but it certainly wasn't, for the last few years.
Right.
And then Jerome Powell, this guy, the chairman of the Federal Reserve, he said inflation would be temporary or transitory. And then a year later, this is an exact quote, we now better understand how little we understand about inflation. So,
that is incredible. Only in the government.
Only in the government. He's supposed to be fixing it.
He's supposed to know. He's supposed to know all the answers, right?
Yeah. And so here's how they're trying to fix it. Here's how they're working. Now this chart, if you can see, it looks a lot like the market, right? The 2000 crash, the 2008 crash, the 2020 short crash. Well, that was not actually the market. This is the federal funds target rate, the interest rates. If you can see, they were 5 and 6% before the dot-com crash, and then the dot-com crash happened, and that caused the Fed to say, okay, we're going to lower interest rates. So they lowered interest rates drastically, and then they started to creep up again, up, and then the market crashed in 2008. So then they dropped interest rates again, and then they started raising rates again in 2016, and they raised them until the market crashed, and that was a really quick recovery, a shortest recovery pretty much in history when the government spent several $1 trillion trying to stabilize the economy during COVID. Yeah. And then so that caused them to drop rates again because of the crash, and they kept them low for COVID recovery. But what did that cause? Spending trillions of dollars, any elementary school student can tell you.
It caused inflation.
Caused inflation. So now they had to raise the rates again. And what do you not see? You don't see a big drop in interest rates yet. I mean, they're wavering. They're going to go flat. They might drop a little. They might go up a little. But we haven't seen them drop a lot. And I think they're waiting until the market really crashes. So this gives you an idea. It really feels like the Fed is almost causing market crashes in some way because they raise them until the market crashes. Okay, so that's what. Now, how bad is the next crash going to be? I mean, this advisor the think tank hedge fund manager says 86% will be as bad as 1929. I don't know if it'll be that bad, but even Morgan Stanley is saying that the upcoming commercial real estate crash is going to be worse than 2008. So why is commercial real estate not a good place right now?
Well, the problem with commercial real estate right now has to do with COVID, or some of it has to do with COVID. Everyone worked at home, and so now people don't even want to go back to work.
Not in the office anymore.
Yeah, not in the office, and so you've got these offices that are empty, and what's happened is they can't lease the property anymore. And besides just the office space, you also have retail commercial space, which is empty because people are buying online. So with that, how does that affect everything?
Yeah, and I mean, a lot of office buildings are worth less than half what they were 4 or 5 years ago. And that's going to be a really big crash. And it's worse than 2008 because in 2008, it was mostly a residential crash. But the commercial market is even bigger. And it is really teetering on the brink of a big collapse.
Right. Well, the regional banks have 40% of their portfolio invested in commercial property. So when it goes, it's not going to be good.
But over the long term, the market's going to go up, and we'll be fine, right? Eventually, it recovers.
That's what they say. Eventually, you'll get your money back.
Yeah, eventually, as long as you don't take any money out. That's the key.
That's the key.
So think about this. Imagine you get a cut on your arm, and blood is gushing out everywhere, and we rush you to the hospital, and the doctor gets ready to stitch you up. And then you say, no, doctor, wait, I want the blood that I lost to come back into my arm first, and then you stitch me up.
I don't know if that's a good idea.
No, it's not a good idea. The first priority is what? Stop the bleeding. Yeah, stop the bleeding. So if you need a transfusion, we can give you a transfusion later, right? But the first thing is to stop the bleeding. Don't lose any more blood. Who's one of the most famous investors in America?
Warren Buffett.
Warren Buffett. And what's his rule number one for investing?
Well, rule number one for him is don't lose money.
Exactly. Don't lose money. He understands the value of not losing money. It's really, really important. And oh, by the way, what's his rule number two?
Never forget rule one.
Exactly. So that's how important it is. It's the first two rules are the same rule. Right. Don't lose money. And in retirement, it's even more important because if you have losses in retirement, that prevents you from having good income. You're going to run out of money real quick.
And you don't have time to recover.
Exactly. So let's look at the historical returns. I mean, the last 22, 23 years, whatever, it's been pretty good. I mean, the market went up from 2000 to 2022, end of 2022. It went up. So take a guess. Put it in the chat, put it in the comments. How much do you think the average return was for that 22-year period, first 22 years of this century? I see 8%.
12%.
6. Yeah, well, the actual number, surprisingly, was only 4.28%.
Wow, that seems low.
It seems really low. So you might be thinking, okay, this can't be true. I know for a fact I got more than 4% return for the last 22 years. Yes, you probably did. And here's why. You probably were investing money for the last 20 years. And most of the growth in your account is from money you put in and your employer matched, not from market growth. And the average growth has really only been about 4.5%, a little under 4.5%. And that's a eye-opening factor. So why is that? Well, the market dropped by 50% in the dot-com bubble.
Yeah, that's a lot.
And when you drop by 50%, how much do you have to gain to break even?
Well, you would think 50%, but it's 100%.
It's 100% you have to gain just to break even. And then the market crashed again 50%. We had to gain 100% just to break even. So for the first 13 years of this century, there was zero return. Before fees and before taxes. We haven't even gotten to those.
Okay.
Remember the three biggest killers?
Risk,
Fees and taxes, right? So this is just risk. And already had zero return for the first 13 years. And so after that, it did really well. Then the next 10 years were some of the best in market history. And so that might tell you something about the next 10 that are coming up, whether you think that will be the best in market history. Probably kind of unlikely. But here's what you could have done. In January 2000, you could have bought a 20-year treasury for a guaranteed 6.86% return.
so no risk whatsoever.
No risk at all. Guaranteed by the federal government. And if you had done that, in 2000 you had $1 million and you invested it for 20 years in the market, you'd end up with $2.4 million with all the ups and downs. Or you'd have $3.7 million in 20-year treasuries with zero market risk.
Wow.
The least risky thing you could have done. And so the solution, obviously, is now that you know this, you should go home, sell everything you have, and buy 20-year treasuries. No. But the point is, like we said at the beginning, risk and reward are not always linked, like people think they are. And so in this case, the least risky thing you could possibly have done beat the market by over $1 million. And so that's something to be aware of.
The problem is hindsight's always 20/20.
Exactly. So it's like this puppy the owner taught to play a shell game. Can you find the treat? Oh,
Did he find it?
there it is.
Ah.
Good job. You found the treat. Now look what you missed out on. Oh. Now he wants to spit it out. He doesn't want that.
It's FOMO, right?
Yes.
Fear of missing out.
So we can't go back 20 years and invest in treasuries or whatever. But you could think moving forward, what can you do to protect from loss and still get a good return? I mean, and Andy, people say, you just picked a specific.
Picked it.
Yeah, you cherry picked it. That was only that one time, 13-year period with no returns. It's got to be better. I'm sure it did 12% other times. Well, this is every 15-year period since 1996.
Okay.
So we put on a year, take off a year, and all of these have less than 9% return. Only one of them was even above 8% on average return. The average was actually 5.16 for all of these 13-year periods, 15-year periods. And so it's crazy. But even that's only 1996. Let's go back further.
Okay.
Remember that 13-year period of zero returns? Before that, there was a 26-year period of zero returns.
Wow.
Before that, there was a 52-year period of zero returns. So
Imagine that.
yeah, putting $1 in and waiting 52 years, you still have only $1. That's crazy. Now, this is inflation adjusted, so it grew a little bit, but not better than inflation. But what is this missing? What is missing from this chart? It's missing the original purpose of the stock market. What was the reason people bought money put money in the stock market? Well, you were investing with a company. You bought a piece of a company. The company, now you're an owner of that company, and when the company is profitable, they pay you a dividend. And so dividends are not shown on this chart. For most of the last 100 years, dividends were a really big part of the market growth. And that's why people were buying stocks in the stock market. Now, when the Fed became active in the 70s and the pension plans went away and 401ks became really popular, then people were stuffing all this money into the market, just buy to drive up the price without regard for whether they were paying high dividends. And so now a lot of companies aren't paying so much in dividends, and that's caused a lot more volatility. and a lot more big gains and then big losses in a short period of time. But there are still dividend-paying stocks, and that can still be a really good place to put money. But dividends are not guaranteed, so just keep that in mind. All right. So what is a bear market? Bear market, we said, is 20% loss or more. So this is every bear market since 1929. And what are some important things on this slide that we should be aware of?
Well, the bear markets last about a year and a half, and it takes about 5 years to recover from the bear market.
So it doesn't happen in one day. We're not going to lose half our money in one day.
No, well, that would be a bad day.
So it usually takes longer to.
It usually takes longer, and so sometimes you don't realize you're in a bear market, and almost until it's too late. And the average loss is 39%. So if you had $1 million, you would lose 39% of that. You would have.
You lose like $400,000.
Yeah, almost $400,000 in a year and a half.
Yeah.
And so when you're retiring, it's real important when when you're retiring, the first 4 years before retirement and the first 4 years after retirement are critical.
Because if you have a loss early on, then you won't ever recover from that unless you leave it alone and not touch it. Well, that means you got to work another 5 years. So it's important to have money protected. So what do you do normally? What is the solution? You diversify, right?
Correct.
So if you're my advisor and I have all my money in this one boat and I wanted to diversify, what do?
I would put it multiple boats.
Okay, so now I got 5 boats. Am I diversified?
Well, kind of.
So what's wrong with this picture?
Well, what's wrong with this picture is all the boats are in the same body of water.
So if a tsunami comes, it's going to crash and tear up all these boats.
And everything's gone.
So what is true diversification? Most people think of diversification as a number of different stocks and different sectors and some bonds and so on. But all of it has still a chance of loss. They're all opinion-based assets.
Correct.
So really you want to diversify between opinion-based and contract-based assets. So what's an opinion-based asset? What are some examples of opinion?
Well, an opinion-based asset would be the market, would be,
So the value is not what
the value
right?
value is determined by somebody's opinion, what they're willing to pay for it. So real estate is opinion.
So if I say my house is worth $1 million, but you only want to pay me $500,000, it's only worth $500,000.
It's only worth
It's
$500,000.
your opinion. It's not mine.
Correct.
Right. So opinion-based asset is somebody else's opinion, not you, determines what that's going to be.
Correct.
And most of the assets we think of as assets are opinion assets. So what about contract-based asset? What does that mean?
Well, contract-based asset would be like a real estate contract. So you're like a rental contract. So you're guaranteed a certain amount of money, or a CD, with a bank.
So something that it's in contract. This is what you'll have. This is the interest rate. This is what you're going to get.
Correct.
So
it's like treasuries, annuities, insurance.
And CDs or banks, like you mentioned. So anything that's protected from loss and that is contractually, what it is.
Correct.
Then that's going to be a contract asset. So you want to really diversify between opinion assets and contract assets. And then the other type of diversification is tax diversification, which we'll get to in just a minute. Okay. So again, insufficient data leads to bad decisions. We don't want to give you have you had bad decisions. So we've given you complete data, hopefully, to make better decisions about your money. Now, what can be worse than a market loss? Well, there's these high fees that can eat away your portfolio. And most people think they're paying what, like 1%?
1%.
To their advisor, and that's often what you're paying. But if you have mutual funds, you could have an average of 1.2% expense ratio there. You could have hidden trading costs, cash drag. Usually when we analyze the client's portfolio, we're finding that they're paying more like 3% or more in fees, not 1%. But let's say we're only paying 1%. How bad is that really?
It doesn't sound bad. I mean, 1% doesn't seem like a lot.
Yeah. So let's walk through an example.
Okay. So I have $500,000 that I'm going to give you to invest, Daniel. And what kind of rate can you guarantee me?
Well, let's remember the market only did 4.2% for the last 22 years, 23 years. So we're going to give you 5%. That's going to beat the market.
Okay, I like that.
All right.
I like
that's what you want in an advisor, is somebody who beats the market, hopefully, right? So that's going to be $1.2 million of total growth over the next 25 years.
That sounds like a lot of money. I don't think I'd mind paying you 1%.
So 1% is okay? It's fair?
I think it's fair enough.
All right. So now remember, I'm going to charge you that every year, though.
Okay.
And
it's
I'm
still
also,
okay, because if I'm going to get that type of return, I don't think I mind too much.
So let's count it up. Over the next 25 years, you end up paying $217,000 in fees. That's crazy.
When you put a number to it, it makes it sound a lot bigger.
But that's not all. There's more. What if you pay me $217,000 in fees? Now, that you're not earning interest on those anymore, right?
Correct. So what's my opportunity cost?
Opportunity cost is another $159,000.
Wow.
So really, you lost $376,000 to just a 1% fee.
Wow,
Yeah.
that can eat away a lot.
Yeah, I
of
mean,
your
remember you got
returns.
1.2 million of growth, right? We take away the fees. That is 31% of your growth that went away to fees. Not
Wow.
1%, 31%. So it's really, really important to minimize your fees. And not all fees are bad. You need to make sure you're getting value for the fees. Okay, but one of the things that's really important to remember is, what are you paying a fee for? What is, you need to know why you're paying a fee, and then you can determine if it's worth it, right? Is it your advisor actually beating the market? Most advisors don't. Is your advisor providing tax advice? Are they a tax attorney? Very few are. And so there may be some other things that you're getting for the fee that is worth it to you, but you need to count up how much you're paying in dollars and really understand that. So here's a case study of ours, Bob and Carol, clients of ours, but there's not their real names. If you're named Bob or Carol, that's not you. And then, they had 1.6 million of assets they weren't using because they had a pension and Social Security, and that covered their basic expenses. But they were concerned; they wanted to spend more, but they were worried about running out of money, and they were sure they were only paying 1% to their advisor. But we found out they were actually paying 3% or $49,000 a year in fees.
Wow, that's
Every
a college,
year.
That's a college tuition.
That's right.
I've got 2 in college right now, so.
And so they were also exposed to a $790,000 loss in the next bear market. And that's why they were afraid to spend money, because they didn't know. I mean, they got to gain 97% just to break even, and it's really tough. So we were able to put together a plan to minimize their fees. We saved them $30,000 a year, $32,000 a year in fees, and we limited their losses. So now they know the worst case scenario is $150,000 of losses, which is only 9%. That's a lot easier to recover from. And so now they feel much more comfortable spending money and traveling and doing other things in retirement. All right, so we talked about risk and fees, the 2 of the 3 biggest killers. What's the third one?
It's taxes.
All right, so we're going to talk about taxes now, and we're going to avoid the political and stick to the action. But what does that mean?
Well, we can't determine who's going to be in office, and
we don't really want to talk about who should be or what they might do.
Right. We
Only
want to
what's-
talk about facts. What's
Yeah.
going to happen?
What's
going to take place? What do we know that's already on the books?
Exactly.
And how can we be proactive?
All right, so you will pay taxes. Resistance is futile.
You really do like Star Trek.
Can you tell? Can you tell? I'm trying to make it obvious. All right, so this can actually be a good thing, not a bad thing. I know it's a scary picture here, the Borg, they're taking over everyone. But no, knowing that you're going to pay taxes regardless, that allows you to pay them on your terms instead of the government's terms. All right, do you think the government has your best interest in mind for taxes?
I don't think so.
No, probably not.
I think they probably want you to pay the most amount of taxes possible, but it's important to know the rules. And
Exactly.
so,
So let's use an example. So forget taxes for a minute.
Okay.
All right. So Andy, you and I are going to start a new business. I know we have Higher Ground Financial Group. Forget that for a minute. We're gonna start a new business.
okay,
I'm going to contribute 25% of the money. You'll contribute 75% of the money,
okay,
and you're going to do all the work because I'm the minority partner. I'm just investing some money there.
Okay.
But I'm going to write the contracts because I'm the attorney.
that makes sense.
And are you good at reading contracts? Or are you going to skip the reading contracts?
I'm gonna not read it.
You're not gonna read the contract. You trust me.
I trust you.
All right. So you trust me to write a contract for you. You're just going to sign it without reading it. Now, 20 years goes by, and now your business is booming. You're making lots of money, and now you're getting around to reading these contracts finally, and you find out that I wrote in your contract, the partnership agreement, that I own 25%, but I can change that percentage anytime I want for any reason, and I can make it 50 or whatever. How fast are you getting out of this
I'm going to
partnership?
be out of that partnership as soon as possible.
So that's crazy. Who would ever sign something like that knowingly, right? Why would you intentionally sign something? But if you have even $1 in an IRA, a TSP, a 401k, 403b, that's the contract you have with the government. Oh, Uncle Sam, I know what the taxes would be if I pay them now. I'm not going to do it. You decide whatever you choose to you want me to pay later, 30 years from now. Whatever you want, I'll pay that then. I don't care. That's not a good arrangement. We want to dissolve the partnership with the IRS as soon as possible. Taxes are going up. We know they're going up in a couple of years. So anything you do now is on sale. Okay, so
It's actually sooner than a couple years. It's like a year and a half.
yeah, it's really and it's getting closer every time, every day. So there's only basically 2024 and 2025 are the last 2 years to have taxes, and even by the end of the year, you can still do some things before we get into 2025 that'll help minimize those.
So what's taking place?
So in
What do
2
we know is
years
gonna happen?
or less, the 12% is going to 15, the 22 is going to 25. A lot of these tax rates are the cuts are expiring, so it's going up. And a lot of people talk about that, but that's not the whole picture. Also, there's inflation adjustments on these brackets. A lot of them are going to change. They may not be the same inflation. So look at this. In 2024, your maximum income to stay in the 24% bracket is $383,000. So if you have $200,000 of income, you have $183,000 of room that you could do Roth conversions or other things and still be in 24% bracket. But in 2026, that bracket, not only does it go up to 28, but you lose 150,000 of room because the top end is 233,000. So if you have that high of income, you actually go up 2 brackets, not 1.
You're in the 33% bracket, which is a 9% increase, which is about 30% increase in your overall taxes.
Exactly. And so it's really important to understand not only are the brackets, the rates changing, but the brackets themselves are going to be shrinking. Most likely. So what can you do to take advantage of the last couple of years? We'll talk about some of those things in a little bit. So then we have capital gains. Now, capital gains are not changing in 2026. And so how do those work? Do you always pay 15% for capital gains?
Not always.
No?
No. You have to earn over a certain amount of money.
So if I have less than $94,000 of income, I'm not going to pay capital gains at all.
And it actually it's a little bit more than that, because you've got your standard deduction.
Yeah,
so it's about 122, 123.
Something like that. Okay. So that's you can use to your advantage, because if all your other money is tax-free, like Roth or something, then you could have 100,000 of capital gains basically and not pay any tax at all. So timing your capital gains is really important in retirement. Now, the real tax system is more complicated than all this, right? If it was just brackets, you can Google those. You don't need a tax attorney, right? By the way, if you do want to meet with us, you can click the link and schedule the call, and we'll be happy to talk to you one-on-one. It's a free 15-minute Zoom call to talk to you about what we can help you with. So anyway, we have required minimum distributions, capital gains, Social Security. These are all unique things that happen in retirement that are going to throw a lot of monkey wrenches in. So let's talk about that. I want to talk briefly about Medicare premiums, because a lot of people get frustrated. If you do these Roth conversions, other things, your Medicare premium goes up.
Okay.
You could be paying $1,000 a month for Medicare. That's crazy. Why would anybody want to do that intentionally? Well, see, as a tax attorney, I don't really care whether you pay more in taxes today. I care whether you pay more over your lifetime or less over your lifetime. And so if I'm going to save you $1 million in taxes by doing a number of strategies, and one of the consequences is you pay a few $100s extra for Medicare for a short transitionary period of a few
years,
then that's definitely worth it. That trade-off is worth it.
That was way better.
Overall, you're still saving $1 million in taxes or more. That's really, really important. And that's the difference between a tax attorney and a CPA.
Well, a tax attorney is proactive versus reactive, whereas
exactly.
the accountant is reactive. They just
and
pay
if
what you owe.
And if you ask your CPA, how do I save money on taxes? They'll say, contribute more to the SEP or to the IRA. And that only lowers them this year. It doesn't actually lower your taxes overall.
You just kick the can down the road.
It's worse than that. You're rolling a snowball down a hill. It's getting bigger and bigger and bigger. So, yeah, I mean, kicking the can down the road is what people say. And to me, that's not even as bad as it is. Snowball's getting bigger.
Well, you'd rather pay tax on the seed versus tax on the harvest.
Exactly. So how do RMDs work? What are required minimum distributions?
Well, RMDs, when you reach a certain age, are required to take a certain amount out of your IRA. Right now it's 73, and so if you have an account balance of $1 million, they determine how long you're going to live. The government knows how long you're going to live. It's hard for us to determine how long you're going to live. So they say you have 26.5 years left.
All right.
And so they divide that, and so you have to pay. You have to pull out $37,736 this year
to pay taxes. But even if you don't want to,
you've got to do it. What are the consequences of not doing it?
So there's hefty penalties. It used to be 50%. Now it's a little less, but it's big penalties. And then you still have to pay tax on the entire amount anyway. So you really better take it out. And we have a lot of clients that come to us for the first time, and they're already in this RMD age, and they're like, well, what can we do? I don't like these RMDs. I have too much. I have other income. I don't need to take this out every year. Well, it's too bad. You didn't take advantage of it early.
Right,
now, there are some things you can do even if you're already past 73. So you can schedule the meeting with us, and we'll be happy to talk to you about that. But what happens every year? It gets worse, right?
Well, it gets worse because you're going to die sooner. So the factor is smaller, which means you have to pay more. You have to take more out each
divide
year.
by a smaller amount. The result is bigger every year until you're 120, and you have to pay half every year. All right. So
120 would be nice.
yeah. Hopefully you all
Maybe.
live to 120, but hopefully we can make your income tax free instead of taxable. So capital gains and phantom gains. How do phantom gains work?
Well, phantom gains work.
By the way, this is not your IRA. So we just talked about IRAs and 401ks. This is for money that's in your brokerage account.
Right.
That's not IRA money. So
Or it's like it's in a mutual fund or something like that. And so what happens is the mutual fund manager, if they want to take some gains, they'll sell a highly appreciated stock, and they pass that on to you in the form of a 1099.
I have to pay tax even though I didn't sell anything. I didn't take any money out.
Correct.
Exactly.
And they can obviously have rebalancing, which is good, but you're gonna have somebody's got to pay the tax.
And it's possible that can trigger a tax even when you lose money. So like in 2022, you could have lost money and then still got a 1099 because they did sell some things that did have gains in that fund.
Isn't that lovely?
Yeah, it's crazy. And so long-term gains can create ordinary income tax because they can have a cascading effect as well. We'll talk about that in a minute. Then there's this 3.8% tax that's on top of all the other taxes because they didn't tax you enough. This is the one they keep talking about increasing because it's only on the rich.
Right.
You know, 250. It might not sound very wealthy, but it is. In the top 10% or so of income earners, and so that's why they're saying, well, maybe we can raise it on that. So we'll see what ends up happening, but at least right now we have 3.8%. And then we have Social Security. So you have a choice, right, of Social Security. You could take it at 62. You could wait till 70. Put in the comments, what have you heard? What do you think is the most common thing people tell you? Should you take it now, or should you wait as long as possible?
Well, you got most people saying,
wait. Yeah,
wait, so you get more money, right?
Right. Yeah. I mean, you get an 8% increase every year for Social Security.
That's nice. Waiting. That's a lot.
Yeah. But we think for most of our clients and most of you on the webinar, you probably want to take it as soon as possible. You don't want to wait. And we'll tell you
why is that? That doesn't logically make sense.
Yeah. Well, we'll tell you a few reasons. First of all, I want to explain what I mean by early. If you're under full retirement age, 66, 67, and you're still working, you can't really take Social Security. Otherwise, you're limited to $22,000 of income from your job. So unless you're making less than that, then you really can't take it before 67. Now, you could retire, and then you could take it, and you won't be limited as far as your other income sources like IRAs and rental properties and things like that. So it's only earned income is the issue. So take it as early as possible means now or at 67 if you're still working.
Okay.
And your one spouse can retire. That doesn't affect the other one. So we'll give you 3 reasons why Social Security is better to take as early as possible. So first of all, it's a tax reason. When I first heard Social Security would be taxed, I was so mad because it's a tax coming out of my paycheck now, and I tell me I got to pay tax again when I receive it.
Well, you're pretty young. I don't know if you're gonna have to worry about paying that extra tax when you receive it. You may not ever.
So for me, it's only going to be a tax.
It's just going to be a tax.
That's even worse.
It's very frustrating.
But for those of you who will get Social Security in retirement, then here's how it's taxed. You take half your Social Security and you add all the other income together. That makes provisional income.
Okay.
Provisional income, if it's over a certain threshold, 85% of the Social Security is taxable. That means 15% of it's always tax-free.
Okay, so 15% I never get taxed on.
Correct.
Okay.
And so how does that really work, and what's the advantage of taking it early? So let's use an example. So Andy, let's say you and your wife are retiring today, and you could each get $20,000 from Social Security, but instead you're going to let your wife's Social Security grow, and you're going to take yours for $20,000. But you need $60,000 to live, so for your expenses, so you're going to take $40,000 out of the IRA.
Okay.
So $20,000 Social Security plus $40,000 IRA. That's only $50,000 of provisional income because half the Social Security counts.
Okay.
And that means you pay $11,000 of your Social Security is taxable.
Okay.
Now,
so my total taxable benefit is $11,100. I love how they call that a benefit.
Yes. The benefit.
I paid the tax. I said a benefit.
That's crazy. So let's say I retire the same year, and me and my wife will both take Social Security now.
Okay.
So that does 2 things. It lets our assets last longer. Our IRAs can grow more because we're only taking 20 out of the IRA.
Okay.
But also our provisional income is less. So taxes are less because $40,000 Social Security, only 20 counts. So 20 plus 20 is 40. And then that's $4,000 taxable benefit.
That's better.
And that's a lot less. And so what does it look like on the tax return? Well, Andy, you pay $2,500 in tax, but I pay 0 in tax.
Wow.
And I still have $2,600 more in my standard deduction that I could be $5,000 richer basically every year, and that I would take it earlier than you.
And you have more money in your
And I have more money in the IRA still.
Okay, it's still growing.
So there's a lot of good reasons. So the tax one was one of the biggest though.
Okay.
And that's a $5,000 more every year. Now, what else do we have? Well, if you take it at 62 and you max out, you made highest income possible for Social Security, you're going to get $2,500 a month.
Okay.
Now, if you wait till 70, you can get $4,500 a month. So that's why people say, wait.
That's $2,000 more a month.
Yeah. But what do you miss? You miss $2,572 for 96 months.
Wow.
That's like a big loss. $246,000 of losses. So you're going to get
That's
more.
significant.
Yeah, it's significant. You're going to get more, right, per month. So how long is it going to take you, Andy, to break even? How long is it going to take you to break even? Are you going to get more?
It's going to take 10 years.
10 years. So age 80 before you even break even. But wait, there's more. It's like the world's worst infomercial. There's also, opportunity costs. Because if you didn't need the money now, you could take it and invest it.
Correct.
Or you could take it and let your investments continue to grow. So now, if you call that 6% opportunity cost, now you're $315,000 of losses, and you're breaking even at age 83. Now, take a guess. What is the average life expectancy of a 62-year-old today?
I'm going to guess 83.
It's exactly 83. And the reason for this is the Social Security Department is not stupid. They want to give you the same amount of money no matter when you retire. So it's always the same amount, except for taxes and inflation and some other things. So on average, if you live to an average life expectancy, you're going to get the same amount of money. Now, there's some exceptions. If you know or you're really confident you're going to live to 100, it may make sense to wait, or if there's some other reasons that
You're confident you're going to live to 100.
Exactly. What's the other reason that we didn't talk about? Well, inflation. Social Security gets inflation increase. In 2023, we got a 3.2% increase for inflation. Do you think the inflation rate was actually only 3.2% in 2023?
I don't think so. I mean,
No.
the government will have you. Would I think they want to brainwash you into thinking that's what it is. But we all pay for groceries and gas, and
Yeah, everybody knows it's been more than that, right? So because of that, your inflation received from Social Security is not as much as real inflation, and that means it's more important and more valuable to you to take the dollars now and do something with them rather than waiting.
and like your dad says, you're never younger or healthier than you are right now.
Exactly. You're never going to be younger or healthier than you are today, and so that's really important. Now you might be thinking, well, why is it that they always say, 8% more every year? Well, yeah, if you have 8% higher chance of dying every year too. That's why you're that much closer to death, so they give you your money sooner.
Right.
But it's the same amount of money. And why do your advisors and the magazines and the newspapers and the TV, why do they all say wait as long as possible before taking it? Well, most of that advice is for the average American. The average American is not you watching this webinar. Why do I know that? Well, because you're watching a webinar about how to save money on taxes. That means you pay taxes. The average American doesn't pay taxes. And the average American, just to give you an idea, the average American made only $35,000 a year during their career. The average American retires with less than $10,000 saved total. So the average American has to work for many, many years past age 70 usually just to put food on the table.
Right.
Social Security is the only check they're going to get, so they need to wait as long as possible. But in your case, if you're watching this tax webinar and you're not the average person, then you can do things differently than the average person. You can take advantage of some opportunities that the average American doesn't have. And that one of those things is taking Social Security early. So let's use another case study. John and Jane married, finally jointly at age 73. $60,000 of combined Social Security, $15,000 of capital gains, and $45,000 of required minimum distributions that they did not want to take out, but they have to anyway because they reached 73. We put them through our tax calculator and found they made close to 50% on or they're paying close to 50% on their money rather than the 12% bracket.
How's
they thought
that
they were.
possible?
Well, their $1,000 required distribution should cause $120 in taxes, right? Because 12% bracket.
Right.
But that caused $850 of Social Security to become taxable at 12% for $102. And that caused $1,850 of capital gains to now become taxable at 15% for $277. So the total tax burden on that $1,000 withdrawal is $499.50.
Wow, so you get this cascading effect.
Exactly, and so this is something you'd want to know ahead of time so you can minimize those
Would your
taxes.
accountant tell you that?
Your accountant's just going to say pay the $499, and if you ask him how to save money, he'll say, "Oh, put more in the 401k or IRA." That only delays the inevitable and makes it worse. So it's really important to minimize your taxes for the long term.
Well, taxes are fun, and so this is a great tweet that was put out. My son asked what taxes are, so I gave him a bag of M&Ms, and I explained that he has to give some to me. I know how much he has to give to me, but he has to guess himself, and if he guesses wrong, he goes to prison.
So that's taxes for you. And so, what are some tools for higher net worth families? If you're not the average American, then what can you do? You diversify, right? We talked about opinion and contract
Based
assets.
assets.
That's diversification. Then there's tax diversification. There's IRA, there's Roth, there's non-qualified, there's other tax-free accounts, there's real estate. These are all taxed differently. You don't want all your money in tax-deferred accounts, only where appropriate. That way you can blend withdrawals. You can take money from different accounts depending on the year to minimize your taxes.
Minimize the taxes.
Okay.
Well, what about like real estate? Like, where should you put real estate? Should you put real estate? I've heard you should put it in an IRA. Is that a smart thing to do?
That's a good question because we want to make sure we know which assets should be held in which type of taxes, right? So real estate, we love real estate for our cars sometimes, but should you really put it in an IRA, a self-directed IRA? No, that's not a good idea. And why is that? Well, if you have real estate inside of an IRA, you have a lot more admin costs and management fees. You have valuations you got to do, and the maintenance, you got to come up with the money to pay for the new roof. Where do you do that? How do you come up with the money? You can't contribute $20,000 into the IRA.
Right,
You're limited. So where are you going to get it? You're going to get a loan. Now the loans are not so favorable for real estate inside of an IRA because they're much higher risk.
Okay.
And then what else are you missing? You're missing out the tax-free income because of depreciation, the stepped-up basis your kids get at death. All the tax benefits of owning real estate are out the window inside of an IRA.
So it's important where you.
It is.
Where
So
you
whatever
put your
your
assets.
investment is going to be, make sure you not only choose is this investment right for me, but also is it taxed right for this investment? There's another type. Can you give me another example of something people often get wrong in the wrong type of asset? Maybe sometime.
Well, when they want to, if they want to, instead of we haven't talked really about Roth conversions yet, but we're gonna talk about that. So that if you want to do a Roth conversion, you want to do it from your IRA, you don't want to take the taxes out from a regular.
So right, yeah,
account.
we want to make sure when we do Roth conversions, we want to leave as much money in the IRA after the conversion as possible. So you want to take it out from some other account. But while we're on the investment type, one of the other things people get backwards is annuities. For example, if somebody wants to put money into an annuity, because they heard it's going to be safer or whatever in retirement, they often are going to sell their stocks and put that in, and that's not a good idea at all, because
they have to pay the tax.
Yeah, you have to pay the tax. If you have let's say you have Microsoft stock and you sell the stock to buy an annuity, you're going to pay capital gains when you didn't need to because it's not an IRA. You didn't need to pay taxes. Then you're going to buy the annuity. The annuity will grow and it'll be taxable income later. So that's even worse. Income tax is worse than capital gains. So you pay one tax when you don't need to, and you create a worse tax later on.
Tax.
And so if you were going to do the annuity, then you should use, like you're saying, the IRA for that because it's not taxed on the transfer. It's still an IRA. Then later the income comes out as taxable, but it already was. You're not creating any new tax.
Additional tax.
So an IRA can be an annuity, and there's no tax on that. Whereas selling stocks to put it into annuity, not usually a good idea. So whatever the investment that you're considering, make sure that you don't just consider is this investment right for me, but also is it going to be taxed in the right way, and is there a better way to tax it? Okay. And then we want to get ahead of the game for RMDs. We would use Roth conversions, so you're right on point there. We're going to have Roth conversions next. Next slide. It's really, really important, and then also CRUTs. So what are Roth conversions? How do they work? I mean, I made too much money. I can't do a Roth. Is there any income cap on doing a Roth conversion?
No, there isn't.
No income
You can
cap.
make $1 million a day, and you can still convert.
So how does that work? I mean, you're paying taxes now, and then all the growth for the rest of your life is tax-free, right?
Yes,
So
that is correct.
That's huge.
Yes.
Now, you can do that with money you already have in the IRA. You can make it Roth, little at a time or all at once. And there is a 5-year rule, couple 5-year rules to be aware of.
Well, if you're under 59 and a half, you have to wait 5 years before you can access the principal. If you're over 59 and a half, you can still access the principal, you just can't access the growth.
So let's use an example. Let's say I have $1 million in my IRA. Today I convert $100,000 to Roth. And you're right, we want to use money from some other account to pay those taxes so that the entire amount stays in the Roth. But let's say we do that. We got $100,000. It's all tax free, and 2 years go by, and now it's worth $120,000. I can spend the $100,000, assuming I'm over 59 and a half.
Right.
But I got to wait 3 more years for the $20,000 of growth because that was growth that happened after the conversion.
Correct.
So that's the only thing to be aware of. And then there's no RMDs. So if you don't want to take it out, you don't have to, and your kids get it with no taxes. Compared to an IRA, they got to pay all those taxes within 10 years. And that's a lot of taxes. They cannot do a stretch IRA anymore.
Right, they changed the rules.
So IRAs are pretty much the worst thing to leave to kids right now. But Roth is great. All right, it's better to pay a little bit more tax now than to pay a lot more later.
Makes sense.
So how much more later? Thank you for asking. I have a slide on that. How much do you actually save in Roth conversions? Well, this is a client of ours who was 60 years old, had $1 million in her IRA that she was not going to spend. This was going to go to her daughter because she had enough pension and Social Security for her income. We calculated she's going to pay $523,000 in taxes just on required distributions over her lifetime.
Okay.
Then she doesn't need the money. She's going to pay another $200,000 in reinvestment tax. Then when she dies, her daughter's going to pay $434,000 to inherit the money. So the total that she and her daughter pay is over $1.1 million. And compared to making it Roth, it's $300,000. That's a lot of money. But it's a whole lot less than $1.1 million. That's an $850,000 savings.
That's incredible.
And what does this not include? This is assuming taxes never go up for the rest of her life. That's not a good assumption. They're probably going to go up. Probably save even more, but at least you know you're going to save $850,000 by converting to Roth or other tax-free accounts. There's a few other types of tax-free assets. So it's really important to know the rules and play by the rules. So you might be thinking, well, even the $300,000.
Where am I getting that from?
Well,
I can't just pop that out of thin
so
air.
one thing we can do is we can spread it out over several years, so you don't
Okay.
have to do it all at once, and that might be make it more easy. But also we can use a CRUT to come up with some of the money for the taxes.
Well, what's a CRUT?
So a CRUT stands for Charitable Remainder Unit Trust. It's a special type of trust that allows you to avoid capital gains on highly appreciated stocks or rental properties.
Okay.
So, for example, let's say you have a rental property right now and you want to get rid of it because it's not so profitable or you're running out of depreciation. So you can only do a 1031 exchange,
Or you got
to pay the capital gains.
You got to pay the capital gains.
Or you can put it into a CRUT, a Charitable Remainder Trust. You donate the property to the trust that we'll set up for you, and then you don't pay any capital gains at all. They're deferred indefinitely. So that can save you hundreds of thousands of dollars or more. Then you get a giant tax deduction up to 50% of what you put in, depending on your age.
Okay.
And on the top of that, then you get a pension from the trust for the rest of your life. Now, this is taxable. That's because you avoid the capital gains. You still pay tax on this income. But you get that income for the rest of your life, 5% or maybe even more if you're a trustee. You can pay yourself a trustee fee. And then when you die, the remainder goes to charity. Whatever's left in the trust goes to charity. So if you don't have any particular charity you own, you can set up a family foundation, like the Trump Foundation, the Clinton Foundation, the Kennedy Foundation, all these, Bill Gates Foundation. These are wealthy people that you may or may not think that they do a lot of charitable work, but they do follow the rules to be legal charities. So you can donate to your own family charity. It's allowed. Or you can just give it to your church as well. And you get all these tax deductions and benefits up front. So let's use an example. A client of ours has $500,000 in Microsoft stock. If she sells it, because she bought it 20 years ago, it's huge gains. She's going to pay over $100,000 in capital gains. So instead, she donates this stock to the trust, saves $100,000 in capital gains, gets a $222,000 charitable deduction.
She can use that for Roth conversion.
Exactly. So she takes the $222,000 over to her Roth IRA, makes the IRA Roth with no tax at all. Then she's going to get $25,000 a year of income for the rest of her life. Now she says, I don't need the income. I already have pension. So what I'm going to do is, since this $500,000 is going to go to my church when I die, I'm going to take the $25,000 income. I'm going to buy life insurance for $1 million for my kids. So that way, instead of giving the stock that I had, we reduce the risk because now there's no risk in the stock. We save the $100,000 capital gain taxes. We convert my IRA to Roth with no taxes. We give the church $500,000 and we give my kids $1 million tax free. all by using this charitable remainder trust.
Wow, is that legal?
It is. It's a strategy that's been
It's
around
an
for a long
incredible
time.
strategy.
Yeah, but most law firms charge an arm and a leg to set them up,
Okay.
and they usually like to only do it for people that have 15, 20, $50 million to put in. And so we make it more accessible for people that have smaller amounts of assets. And so we'll talk to us. Click the link and schedule the appointment, and we'll be happy to talk to you about whether this is right for you. It may not be the best thing for you, but there could be other strategies that are also useful. All right, how high have taxes been historically? What is the
They feel high now, and I know they're going to go
30
up, but they still feel high.
37% is the top bracket now. So take a guess. Put in the comments. What is the highest taxes have ever
We
been?
got 75,
What? Are we in a communist country? 75%?
80. Wow,
80?
somebody said
No,
80.
you're actually close. It's 94% was the highest taxes have been back in the 40s. And that's scary. But
That's a lot.
it's not the most surprising thing about this slide. The most surprising thing is the slide, the blue,
The lowest tax
the
rate.
blue line, the one only $10,000. Is it blue or purple? I'm colorblind. Is it
It's blue.
blue? The bottom one is blue. Yeah. So
It's blue.
anyway, the blue line at the bottom, only $10,000 of income. Back then, it was 40%.
Wow.
So you might be in a lower bracket when you retire, but the bracket itself could be significantly higher. So that's really important to
Well,
be
if you
aware.
look at the tax bracket, it's all based on war. This is World War I here, and the tax went up to pay for that. Then World War II is even higher, and obviously it's come down since. But we're in pretty uncertain times right now. We got a war in Israel. There's a war in Ukraine. Who knows what's going to
Exactly.
happen?
So the taxes are probably going to have to go up. Pretty much everybody expects it. It's just a matter of when and how much.
And might have to do something with the debt as well.
Yeah, that's probably going to be a big significant factor. Again, insufficient data causes undue stress. We don't want you to be stressed. If you're getting the impression that we're trying to make you stressed, that's not true. I am showing you why you might be stressed and then giving you the solutions to not be stressed. How do you not be stressed? What do you remove? The three killers:
Reduce risk, fees, and taxes.
risk, fees, and taxes. If you get rid of those are the three biggest stress causes in retirement. Most of our clients retire with 50% more income than they had before working with us. They retire 5 years sooner than they were able to without us. And they save over $1 million in taxes by doing so. So that's the type of thing we cause, and that's very much stress relieving.
Right.
All right. So again, quickly, I wanted to go over. There's also estate taxes, and for the next couple of years, it's really $13 million is the amount you can leave without a tax. It's going to go down significantly to like $6 million or so, and there's a 40% federal tax on the excess. So if you have $3 or $4 million in assets now, and you're spending it slower than it's growing, then you'll probably be over that by the time you pass away, and you need to worry about that excess estate tax. Now, gift tax is the same, so you can give away money, $18,000 a year, with no reporting, or millions of dollars with just reporting that you gave the money away, but there's still no tax on that. So talk to us if you want to do some gifting ahead of time. And then there's estate planning, wills and trusts. Why should you have a trust and not just a will? Well, a trust is more efficient, it's more smooth. It goes outside probate, so it saves months or years for the kids to inherit. And then also, it is private. A will is public. Everybody knows who you leave the money to, how much you had, and all that. Even your friends and neighbors and enemies, they all know that. So trust is more private, it's more instant. And if you have real estate, you really need a trust. And there's other special types of trusts, which apply to some people, but not all. And then there's CRUTs, which we talked about, another type of trust that can give you big tax deductions. Beneficiary designations trump everything.
This is really important.
Yeah. So can you tell me a story?
Well, I have friends of mine who wife passed away, and she had a separate bank account. I'll just use this as she had a separate bank account. I think there was a couple $100,000 in it, but there was no beneficiary on her bank account, and so that had to go through probate. So it was their money, and he couldn't touch it.
It's crazy. And even if you have the beneficiary, if the beneficiary doesn't match your trust, maybe it's an ex-spouse from 20 years ago.
Good.
They get the other half now when you die. It doesn't go to your current family. So that's really important to make sure it matches your estate plan. And then there's different types of assets to leave. Real estate is great. Mutual funds great. Stocks, bonds, because there's a stepped-up basis. No capital gains when you die.
Okay.
But definitely make sure it's in a trust if you're going to do it. And then inherited IRAs are the worst possible thing to leave to the kids because they're taxed and they have to pay all the tax within 10 years. Roth IRAs and life insurance, these are the best things to leave to kids. There's no tax, and it's the most efficient, most tax-free way to leave the money to the kids. And why do I keep saying you have to have a trust, not just a will for the house? Well, these are your 3 kids. They inherit the house.
They look really happy. They got the
After a
house.
lengthy probate process, they finally get the house. Now, I want to sell it. I want to rent it. I want to move in. Now, these are your 3 kids.
No, they're not so happy.
You don't want this to happen to you. You want your trust to say the house must be sold or the house may not be sold. Whatever the case is, you decide, not your kids. All right? And then other retirement pitfalls.
Well, I mean, market risk is huge. It's just it's a tax. The money's gone. You can't get it. But like when you give the money to the IRS, you don't get it back. And it's the same thing when you have market risk.
Long-term care costs. You have a plan for long-term care, have a plan for inflation, and then also boomerang children. The kids move back in after they're grown and gone. And so we have a solution for boomerang children right here.
Get in an RV and go away so they don't know where you are.
If they can't find it, they can't move back home, right? So now let's say you decide, okay, this is interesting information on reducing risk, fees, and taxes. And so if I schedule the meeting, if I click the link and schedule the meeting with you, what do I get? Well, we do a stage 1 Zoom call. It might be a couple calls. It's getting to know you. We identify where you are, understand your dreams, where you'd love to be. If money was unlimited, what would you possibly do? And Andy, how much does this cost for us?
It costs absolutely nothing.
So it's free. There's no cost to this call and no obligation. And then if you do that and you want to go forward and you actually get a plan, we give you stage 2. It's a pre-qualification. Remember, with us, without us. With us, without us, right? So we give you a tax plan, a risk analysis, a fee analysis, income plan, talk about estate planning, and we identify what it costs to actually implement the plan. But this plan is a $6,000 value. We give this to you for only $500. And we have a money-back guarantee. It's a fiduciary plan.
So if you don't feel there's value,
you
and
can
what
ask for
we
your money back.
provide you, then you can ask for your money back.
And so this, you don't have to decide today. You just click the link and schedule the free call, and then we can do this afterward. If you decide you want to use our firm, because you still have no obligation. Once you do this, you can still use your current advisors. But if you want to use our firm, then we'll talk about what the products and services would be, how much they cost, and all that. Implementation. And a lot of the changes we make are very small tweaks, and it can make a huge impact in minimizing your risk, fees, and taxes. So we're running up at the end of our time here, so we're going to go ahead and sign off. But go ahead and click the link and schedule the appointment with us. We'll be happy to talk to you one-on-one and get you that plan to reduce and minimize risk, fees, and taxes.
Well, hey, we appreciate your time and have a great day.